Hey guys, welcome to our September market update from Tyler McClay Realty Group. Tyler McClay, thanks for joining us. I'm going to get right into it. Lots of reason to be excited in September. Lots of reason to be excited at what's to come. Normalcy has returned to the market, and confidence, predictability, it's here. All the trends that we were paying attention to, all the market data, all the inflationary shifts, it's all kind of come to fruition, and we've avoided recession. We never had, by definition, 2 consecutive quarters of negative GDP growth, okay, which is awesome. We had that soft landing that we thought would be elusive or tough to achieve as we came out of the pandemic, but a lot of the market factors, market movers have responded accordingly, and some sophisticated monetary policy being deployed. Okay, so let's get into it. Good news coming from the Bank of Canada just last week. Quarter point cut. This is our 3rd consecutive rate cut. This is awesome. Okay, we're starting to actually see now some, I guess we could say, monetary impact or impact on affordability. The first cut, everyone was, no big deal, doesn't mean anything, doesn't affect my purchasing power much. But 3 in a row, 3/4 of a point, I mean, that is significant. We've seen variable rates drop significantly, and we've seen fixed rates come down to a really, really agreeable level from a benchmark perspective, from a pre-pandemic level. And we're getting there, okay? We're not done yet. Now, what's interesting about this cut is, yes, it was anticipated. We did anticipate the quarter point cut, but there was some conversation with inflation working its way down from 2.7 to 2.5% that we could have seen a half point cut. This is the right decision from my perspective. We can't accelerate the rate cuts too quickly. We need to ease into it. It's like anything, right? When it's a easing into a shift or a change, especially the magnitude that the Bank of Canada rate cuts have on the economy as a whole, it's got to be gradual. And that graduation or deceleration of rates is awesome. Now, we're pretty confident we're going to expect some more rate cuts as we head into, I'd say, the 4th quarter of 2024. Another announcement in October, another announcement in December. And when we hit December, that's when I wouldn't be surprised to see a half point cut. Now, economists and the economy as a whole has actually already priced in rate cuts all the way until March, so consecutive rate cuts all the way until March of 2025. By what rate is up for debate. That rhymes. But basically, we can confidently assume or predict that based on the overall, we'll call it health of the economy and cooling of inflation, that we're going to see more cuts. And overall, it's good for the economy, really good for buyers and sellers as well. Okay, it's good for the health of our real estate market here, and a little more along the lines of what we've been accustomed to from a transaction volume perspective and a pricing perspective. Okay, so how many more cuts this year? Well, hey, I told you we've priced in until March of 2025. Markets are expecting those 5 cuts, and in combination, that's a whole point and a quarter from where we're at now. That's 2% from our high of 5%. Okay, that's pretty good, pretty cool. That brings the overnight rate from the Bank of Canada to, we'll call it 3.5, based on these estimates. But 3.5. Now, sorry, I said high of 5.5. We are optimistic as a whole about the economy and about the continual rate cuts. Again, we move too fast, that's going to have adverse effects on the economy. But if we move too slow, then affordability across the board just kind of gets tough for the majority of the population. That being said, we don't drive the same car we drove when we first bought a car. We don't have the same. My phone's plugged in. We don't. Our iPhones have come a long way. Or if you use a Samsung, they didn't exist when iPhones first came out, right? The smart version. But my point is that we've come a long way in a lot of capacities, and I guess similarly, monetary policy has as well. We're a lot more sophisticated than we were in 2008. We're a lot more sophisticated than we were in the early 90s, and we can put these tools or policies in place to soften that landing. So what does this ultimately mean? Well, it means money is going to get cheaper again, and it should, I don't want to say stimulate the economy, but reinstate the confidence in a levelly balanced transacting economy, if that makes sense. So, when I say stimulate the economy, I don't mean things are going to go nuts and go bonkers like COVID again, but we're going to get back to normal. People are going to be comfortable spending money within our economy, contributing to positive economic growth as a whole and combating that inflation. Inflation is going to normalize around the low twos. Okay, now I've talked about it before. I'm going to touch on it again because it's weird. Canada is the only G7 country that includes, one of the only countries in the world that includes mortgage interest and rental inflation in our core inflation figures, which is weird. When we remove that from the basket, our inflation is well below 2. But for the sake of the conversation, target rate around 2% in inflation. This is a gradual shift, gradual change. By cutting the rates, it's not going to spark inflation. It's just not going to happen. Okay. Now, big part of these interest rate cuts, a big part of this confidence from the Bank of Canada and their ability to feel confident about cutting rates is that our inflation has achieved a 40-month low, 2.5%. And again, if you're new to my channel, new to my page, please like, subscribe, follow, all the stuff all the YouTube people say. Do all that. We'd appreciate it. Keeps our content coming out. But just to touch on what inflation is, higher inflation, it devalues cash. It devalues money. Okay, higher inflation contributes to the higher cost of life. When inflation is manageable, it's unavoidable. In most cases, I will say, but in a developed economy, it's unavoidable. In most cases, we want to hover around that 2%. Okay, it maintains with wage growth. It's manageable. It's absorbed, and for those reasons, it's a big contributor, or has been one of the biggest elements that's been paid attention to in the Bank of Canada's decision making. Okay, we're starting to see a shift actually away from inflation and more to job markets. The Fed in the U.S. and the Bank of Canada, they're kind of okay with inflation now, and they see that trajectory is working its way down. And you can see from pre-pandemic all the way to 2000, other than the financial crisis, you can in 2008 you can see negative inflation, which is always kind of scary and freaky. You can see that we've been somewhat stable hovering around the average of 2% inflation, and that's good news. Okay, so job markets are definitely playing a role. Now, in terms of population growth, it's been talked about. It's been talked about a lot, and specifically in the Toronto core. You can see the graph here. Percentage change in Toronto population, it's hands down and will continue to be one of the fastest growing regions in North America. Okay, now why? There's a number of reasons why. I mean, we need immigration, we need population growth to service our Canadian economy as a whole, but Toronto specifically is special. Toronto specifically is unique. We are a melting pot of diversity, which attracts foreigners because there is a sense of familiarity, okay? From a Canadian perspective, Toronto is, I would probably argue, one of a kind. It's the only major metropolis in Canada, okay? Yes, Vancouver, right? You guys are like, oh, what about Vancouver? Yeah, Vancouver, it's great, it's huge. But in terms of our finance industries, tech industries, healthcare industries, Toronto is the bee's knees, okay? Montreal, language things, always going to hold them back. Edmonton, you've got Edmonton, Alberta, and Calgary, Alberta have seen some growth, but they're behind. Okay, and then the Maritimes, they're growing, but again, they're never going to hit Toronto's levels of attraction. Okay, the jobs are here, the high-paying jobs are here, the confidence and quality of life, it's here. Any metric you look at, the happiness metric, the quality of life metric, all these studies that they do, Toronto's always consistently top 10 in the world. Okay, but Canada had 4 of the top 6 in North America. Toronto is again holding steady in that number 1 spot. Okay, so population growth obviously contributes to demand in real estate, and it's the supply side that's the issue that we just can't keep up. There's a lot of talk about curbing the demand side. You can't. How do you curb demand? Right? Limit population growth, limit immigration. It's not enough. It's not enough to solve the supply-demand imbalance that we have in our market. It's just not, never will be. The issue or crisis will be solved on the supply side, and there really is no smart solution. We're trying to build faster. We're trying to build more. Developers are de-incentivized to deploy their capital and build because the razor-thin margins are not as enticing because we're not too confident in the price of real estate that we can generate for those right now, because we've had a stagnant economy for the last 18 months, stagnant real estate market for the last 18 months. Okay, so it's to be expected that our appreciation will continue to be rock solid, right? You take a 40-year moving average of growth in Toronto real estate, GTA real estate, you're looking around 5-6%. That's huge compared to North American wide, and we will get back to that sense of normalcy or expectation. Of course, COVID accelerated those gains. That's why we've had stagnation for the last 2 years. This is not a surprise. Okay, a lot of this stuff is predictable, because if we're going to be on average 5-6%, we had 30% growth through 2 years of COVID, so that's 3 times as fast as we should be. If you condense 6 years of growth into 2 years, what does that mean? Probably 4 years of slower growth, and we've had it for the last 2 years, coming up on 3 years. There's a lot of good things in the economy, a lot of good things from a fundamental perspective, so I think we're going to get back on track a little earlier than a full 4 years. There's a lot of reason, and it's not just hot air why the market is appreciating the way it is. We're not building fast enough to support the growing population. We've got the jobs, we just don't have the available units. Okay, so very confident over the next 3 to 5 year span. I mean, downtown core is the place to put your capital. So I should have jumped to this slide before. Is there a supply shortage coming? Yeah, developers are de-incentivized to build. The lack of available land, it's not there. The cost to build, hard costs, soft costs, the labor, the labor market is not quite there. Okay, so it's really hard, difficult to find the skilled labor right now, and there's only so many projects happening at a time. Once we get back to a building boom, I'll call it. I mean, building boom. How quick can you move in Ontario? On average, sorry, I like to rant. You know I like to rant, but hopefully it's all knowledge for you. The average time it takes, if I was to buy, let's not even say a block. I buy a gas station in the core Toronto. Okay, I want to convert gas station to condos, and I want to build. On average, in Toronto, it's going to take me 7 to 9 years from the moment I buy the land until the moment that a buyer is walking into their unit, 1204, 2-bedroom suite. 7 to 9 years. Less than half of that is the construction process, 3 to 4 sophisticated builders. Of course, there's only so many builders that can build in core Toronto because of lack of staging areas and experience and skill that it takes. But like the first 5 years, and it blows my mind, is the approvals, the permitting, the shadow studies, the bird studies, the noise studies, the prep, if it's a gas station, why am I drawing a blank? The soil. It'll come to me. Anyway, the word for remediation of the soil. There's the word. But geez, yes, there's a housing supply shortage coming. 100%. 1,000%. How could there not be when you look at the math and you look at the numbers? So yes, there is. Might not seem like it right now, a little excess inventory. That's because we're still in recovery mode. There's been stagnation. Okay, there's been stagnation for good reason. But yeah, is it coming? Of course it is. Yes, of course. There's only so much land and lack of building. Okay, and here you go. So slowdown in building permits. In spite of record population growth, single-family building permits have fallen to 40-year lows. Let me say that again. 40-year lows. When all you hear on the news and from politicians is housing crisis, housing crisis, housing crisis. Let's build some homes. 10 years, they want to build whatever the housing bill is. I don't pay attention because it's complete nonsense. 1 million homes in 10 years? Good luck. Good luck. Look at the build permits. Look at Ontario. Okay, people want to be in the core, people want to be in Toronto. The periphery is growing, but we can only grow so far because we don't have the transit infrastructure to get to the core where the jobs are. We might see some periphery markets grow. Okay, what we will see grow is the periphery cities, the Hamiltons for sure, the Oshawas, the Barries, the Nodes. Okay, we need more growth in housing in those middle periphery. I kind of call them desert markets myself, like the Bradfords. Okay, the Georgetowns, stuff like that. Where it's just housing, like you've got nothing else. You've got houses and nothing else. They're going to appreciate with the market because we have such a lack of housing, but there's better options. If you want to live there, live there. It's a great place to live. They're both nice places to live, but from a dollars and cents perspective, the value doesn't support the prices being paid. That being said, Can the supply issue be solved outside of the core? Sure. We have land, we have space, it's Canada, man, second largest country in the world. Developable area, though, interesting how little it actually is. But that being said, the attractive land, the attractive space to build homes, not a ton. There's enough to curb the supply imbalance, but never, ever, ever is that going to be possible in the core. Canadian GDP is lagging. This is very interesting. Okay, so we're pretty confident in the growth. To me, this tells me that it's an opportunity. Okay, the U.S. has kept up and maintained and recovered more quickly than us, but it's just not keeping up with our population growth. It's just not keeping up with our population growth. It will, and when it does, we're going to see some serious growth. But to me, this screams opportunity. Okay. Oh, would you look at that? My next slide is opportunity. There's no space for my face here. That rhymes too. Wow, 2 rhymes, 1 video. You guys lucked out. Again, there's another reason to like and subscribe to our channel. Here, we'd love it. We'd appreciate it on YouTube. Like, subscribe, and drop us a line anytime. Like, you know how to find us. So if you have questions, we're really easy to find. Okay? Close the gap between the tech video and human element. Just give us a call. Anyway, where's the opportunity? Well, hey, hello, what's going on? Monthly mortgage payment required to purchase a typical home. That's going to continue to drop as rates continue to drop. And the affordability index, let me move again. There you go. That's a better spot. Anyhow, affordability in terms of mortgage, this slide where my face is now, or this chart, it's working its way down, okay, because the cost of borrowing is going to work its way down. You can see a very strong correlation with this graph if you look right around the 2021 mark when we came into the recovery mode from the pandemic and rates started to go up. There's a direct correlation between higher mortgage rates and obviously monthly mortgage payment. Okay, so as rates drop, that payment will come down. It's pretty self-explanatory. Housing affordability index. Housing, I mean, it's a premium to live in the core. I don't know what else to tell you. I mean, housing is a right, not a privilege. I agree. Housing is a privilege. Housing is a right, not a privilege. But home ownership, I believe, it's a privilege. Okay, there's options to rent, for sure. There's options to rent, have a roof over your head, but home ownership is a privilege. And the affordability with the rates we've had and the lack of growth we've had and, stagnant wage growth in line with a stagnant economy with higher inflation makes affordability as a whole tougher. But yeah, I mean, we know it's a thing. You look back in the early 90s, right? Percentage of incomes. We're right there. And my take is that that's going to work its way down in correlation in line with interest rates dropping. So I see huge opportunity. And obviously when money gets cheaper, what do we see to happen to asset prices? When mortgage rates drop, we see asset prices go up. It's a natural inverse relationship. Okay. Condo market, yes. Currently, we are oversupplied. I'm going to cover my logo. You know my logo. Currently, we're oversupplied in the condo market. Okay. Resale market. Now, why? Why is the months of inventory so insane in the downtown Toronto market? These are July stats here. Months of inventory is, I don't know if you can see my mouse on here or not when we screen record. I think you can. But 6 months of inventory, man. And then we're right around there now in September as well. August was similar and September similar. Why? Well, I'll tell you why. The profile of buyers for condos is much different than the profile of buyers for single-family detached homes just outside the core or the periphery of the core. Why? A lot of condo owners are first-time buyers. They're going to be more risk averse in markets like this. They shouldn't be. You guys should be buying, but you're going to naturally be more risk averse when we're not sure what's going on in a volatile economy and volatile real estate market. Okay. Again, last slide was opportunity. This is opportunity. As the market recovers, as the confidence returns, as mortgage rates drop, as we see populations continue to grow, as we see wages continue to grow, as we come out of this stagnation, this is going to correct very quickly. I'm going to say by the end of 2025, if not early 2026. Okay? So screaming opportunity here. Yeah, we're oversupplied. Yes, because the buyer profile of these units is just not in the market right now. They're just not in the market. They're just not. They're more hesitant. Okay? The affordability has hit them harder than it has, a repeat buyer, someone selling and buying in the same market. Who cares? I lost $100,000 on my house, but I'm paying $100,000 less on what I'm buying than what it was at the peak. So it's all relative. Okay, that's my take on condos. And again, ties into where I'm going here. Condo completions, build permits are down. New condo builds are down. So you look forward to 2028. Again, I said we're going to be corrected by late 25, early 26. By 2028, this chart shows the amount of condo completions. Okay, we've got a lot coming in 24. We know there's going to be a lot coming in 25 because these are the units that are completing or taking occupancy, we'll say, from when they were sold in the peak and the boom of the market 2019, 2020. Okay, I told you on average 7 to 9 years for start to finish. Usually starts selling around 5 to 6 years prior to occupancy. So pretty, again, no surprise here. Rarely am I surprised because you read between the lines, you pay attention to the stats. This is what makes sense, okay? Real estate boom, you sell a bunch of pre-con, takes 6 years to build pre-con. Hello, there's going to be a lot of units coming to market 24, 25. But look at 26, 27, and 28. This is where that lag from we'll say early 2021 till now, okay? 3 years. That's where that lag is going to catch up. And that 2028 figure that you see, again, I can't see if you see my mouse, but you can all read 2028. Guess what's going to happen in 2029, 2030, 2031? What do you think the market's going to look like? There's not going to be many new units, many new condos coming to market. And what's that going to do? Continue to push the levels of supply down as the demand goes up. And what does that do when there's such a significant imbalance? Obviously, that luxury of home ownership, that privilege I spoke about to live in a certain place, certain city, there's going to be a price to pay. There's going to be a price to pay. And that price is going to be rapid appreciation and acceleration in our condo market. So it's coming. Let me do what I always do. Crystal ball. I'm going to tell you one more time because I don't do enough of this, but I'm going to say it again. What I can see in your future is that you're going to go like this video, maybe drop us a comment, and subscribe to our channel. Come on, help us out. We'd appreciate it. Next Bank of Canada announcement going forward, 2023. Sorry, I'm talking a lot. 22 minutes straight. That's what I do. Anyhow, next rate announcement, October 23rd, 2024. Based on what we're seeing today, it's going to be another cut. I'm going to say quarter point. Could be half point. I don't think so, but nonetheless, I think we're going to see a cut. Going forward, lots of confidence is back in the market. We're going to see transaction volume probably pick up throughout the fall market. Seasonality, we know, mid-December, things kind of turn off. People turn off the thoughts, the taps into holiday mode, and we'll see that kind of pick back up and follow through in January, early January, for a very confident, very awesome 2025. So, sellers, I'd say you missed the opportunity in the summer to kind of be one of few listings on the market. We're seeing listings come back. We're seeing confidence from sellers because they're listing, and the buyers just haven't come back yet with the same aggression that they would be and should be. But we will see that persistence and confidence come back at a pretty stable, predictable level. Buyers, based on everything I just talked about, you guys should be just rearing to go. Calling your mortgage brokers, calling your agents. If it's us, great, call us. If you've got an agent, call them. And start putting a plan together, because we're not going to see an opportunity like this again for what I'm going to say is going to be probably another 8 years to a decade, assuming there's no black swan events or force majeure kind of things happening in our markets, in our world. I feel good about the Canadian market from a political standpoint. I mean, yeah, there's things we're all aggravated with, but I mean, won't get into that. I mean, from a confidence perspective in home ownership, as well as bank economic kind of certainty and comfortability levels. So pretty stable there. Paying attention to the economy. I don't know how quickly we're going to recover, but I'm really confident in 2025. I think we're going to see steady, growth in transaction volume throughout the end of the year, and then prices will start to actually shift into the new year in 2025. So that being said, you've got a window. You've definitely got a window here to take advantage of. But surplus of listings, like for buyers, surplus of listings and confidence in an appreciating market. Let's do it. Talk to your mortgage broker about a shorter term fixed rate or something to that effect, right? 1-2 years, and take advantage of the lowering rates, but also the lower price points. So anyway, with that, I'll let you go. Have a great day. Have a great week whenever you're listening to this. We hope you enjoy it. We hope you like these. And if you ever have any questions, you know where to find us. Okay, so I'm Tyler McClay Realty Group. Have a great day. Please like, follow, subscribe, all the good stuff. Thanks, guys.